Hi, this is David, and it's the Leverage Hedge where we turn volatility into opportunity. This week was interesting. The market finally remembers something it hasn't thought about for a while: fear. War headline escalated, oil prices moved higher, job data came in weaker than expected. None of these events individually crashed the market, but together they create something the market hates: uncertainty. And uncertainty shows up quickly in one place: volatility. Let's look at the numbers. QQQ fell by 1.24%, SPY dropped 1.98%, and TQQQ fell by 4%. Not catastrophic weak, but definitely uncomfortable. Now let's look at the portfolio. The account closed at 94,714. That's down just 0.07% for the week. Still slightly negative for the year, about 5.29%. But this week, something important finally happened. The portfolio outperformed all the major indexes. And the funny thing is, I actually slept extremely well through the entire turbulence. I know the market was up and down, gyrating. Every day you open, it was down like 2%, then climbed back a little bit. But I slept through all of it. In fact, the market was so manageable, I almost forgot to check the portfolio. That's the whole point of building a structure like this. When the market gets nervous, you don't have to. The reason comes down to volatility. The market itself was not horrible. The kind of drop I've seen 12% of the time on SPY and 24% of the time on QQQ. So nothing extreme. However, multiple bad news and back and forth on the market, and most important of all, the spike in oil prices brought in a lot of fear. During the week, the VIX spiked sharply, jumping from the mid-teens towards 30 at one point. That's a huge increase in market anxiety in just a few days. And volatility is extremely important for this portfolio, because inside the structure there are options. When volatility rises, the value of those options increases, sometimes even faster than the market falls. So when the market dropped this week, the increase in volatility helped absorb most of the loss. That's why the portfolio barely moved while the index fell much more. Think of the portfolio like a spring. When the market becomes nervous, the spring starts to compress. Fear loads energy into the system. Nothing dramatic happens yet, but the tension is building. And when the market eventually makes a large move, the stored energy can release very quickly. That's when this structure starts to shine. This week was not the payoff. This was more like the first signal that the environment is changing. For the past 2 months, the market has been unusually quiet. It's the tightest trading range in 20 years. That's actually the worst possible environment for a volatility strategy. But this week, the market started to wake up. Volatility spiked, fear entered the system, and the portfolio finally began to behave the way it was supposed to. If the market goes back to sleep again, the portfolio may continue to grind sideways. However, markets have a strange habit. It's called volatility cluster, especially when the market is going down. Normally, the chance of a 2% down week within the next 2 weeks is about 25%. But after a 2% drop, like we just had this week, the probability of having another 2% or more drop in the next 2 weeks jumps to 34.9%, about a 40% increase to what would usually normally happen. And if the drop were 3% this week, those odds would rise to 46.9%, almost a coin flip. So if the volatility keeps expanding, or the market makes a large directional move up or down, the structure can start working much more aggressively. So this week wasn't the result, it was the setup. The system is beginning to load energy. And we will see the market does after this point. I am too embarrassed to beg for you to subscribe, but if you found this interesting, share it with someone who may like it or who may benefit from it. Let's build our wealth together slowly and smartly. For entertainment only, not financial or investment advice.